So let's watch this video first.
Andy, you nuts? Keep your eyes on your mouth, man. Andy.
Well, all right, you're going to pay some taxes, but you'll still end up with...
Oh, yeah. Maybe enough to buy a new car, and then what? I gotta pay tax on the car. Repair, maintenance, goddamn kids pestering you to take them for a ride all the time. Then at the end of the year, you figure the tax wrong, you gotta pay them out of your own pocket. I tell you, Uncle Sam, he puts his hand in your shirt and squeezes your tit till it's purple. The man never gets a break, that's the truth. He said rich get rich suffer.
Keep talking. No.
Some brother. Shit.
Hey!
Mr. Hadley, do you trust your wife?
Oh, that's funny. You're gonna look funnier sucking my dick with no teeth.
What I mean is, do you think she'd go behind your back, try to hamstring you?
That's it. Step aside, Mert. This fucker's having himself an accident.
You don't push him off the roof. Because if you do trust her, there's no reason you can't keep that $35,000.
What did you say?
35,000.
35,000.
All of it.
All of it?
Every penny.
You better start making sense.
If you want to keep all that money, give it to your wife. The IRS allows a one-time only gift to your spouse for up to $60,000.
Bullshit. Tax-free?
Tax-free. IRS can't touch 1 cent.
You're that smart banker with...
Okay, so this is a scene from the critically acclaimed film, The Shawshank Redemption. In this scene, the main character, a banker who was sent to prison for murdering his wife, tells the head prison guard how to save taxes on the gifts he received. But we won't be discussing gift taxes or what we refer to as donor's tax here in the Philippines. Instead, we'll be talking about another form of taxes, which is the corporate income tax and the substantive procedures that are typically used to audit it. So welcome to today's training session on how to audit the annual corporate income tax and related accounts under Philippine taxation through the performance of substantive testing procedures. Just like in the other training sessions that have been so far conducted, I would like to emphasize that this training for income taxes focuses on certain substantive testing procedures only and assumes that no tests of controls were performed by the audit team. Tests of controls and their impact on substantive testing will be discussed in other training courses. But before I start discussing how to audit corporate income taxes, I would like to highlight that the client is responsible for the computation of its income tax, including the underlying supports for such computation and even the disclosures made to the financial statements. The auditor's responsibility is only to verify whether the computed annual corporate income tax and the related deferred taxes are reasonable or not. So let's start by knowing the objectives of this training session. What are our training objectives for this session? At the end of this training, I hope that you would have gained a basic understanding of income tax and deferred taxation, learned about some of the common risks relating to income tax and deferred taxation, learned the principal audit objectives in auditing income tax and deferred taxation, and finally, learned about the substantive audit procedures typically performed on income tax and deferred taxation. This training will be conducted in the same order as these training objectives. So, let's start with Philippine taxation. An acclaimed international economist who held a lecture here in the Philippines a long time ago said that the Philippine tax system is a complicated mess because of the different taxes imposed on different income levels and different industries. For example, the economist said that there are too many imposed tax rates in the country and that the more progressive and bigger industries are taxed more than the less progressive sectors, such as those in the agriculture, for instance. Well, many taxpayers, I think, actually agree that the Philippine taxation system is quite complicated, especially compared to other countries. even with the passage of the Tax Reform for Acceleration and Inclusion Act, which is more commonly known as the TRAIN Law, and the enactment of the most recent one, the Corporate Recovery and Tax Incentives for Enterprises, or the CREATE Law, our country's taxation remains confusing to many taxpayers. There are just too many tax laws, rules, and regulations that many taxpayers do not know about. And not knowing the rules can consequently lead to errors in the computed income tax. And then comes deferred taxation. I believe that many taxpayers, especially those non-accountants, are still not really familiar with the concept of deferred taxation. These people may see the deferred income tax and the nature of the account in their financial statements, but they actually do not know how they are computed by, for example, their accountants, or how deferred taxation even works. Some even get confused with it and think that deferred taxation is a tax rule that came from the Bureau of Internal Revenue, or the BIR. But just to clarify this matter, the calculation of current income tax expense and income tax liability is a computation that should be done following the tax rules and regulations issued by the BIR. However, deferred income tax is a computation that is done under the requirements of the accounting standard on income taxes, such as PAS 12 under the full PFRS, Section 29 of the PFRS for SMEs, or Section 23 of the PFRS for small entities. So I hope this clears the matter up. And having said that, let us now discuss the common risks related to the corporate income tax. Following are three of the common risks associated with income tax and deferred income tax that we will discuss in this training session. But before that, I would also like to point out that due to the current state of our economy, the Department of Finance has reinvigorated its rate program, or Run After Tax Evaders program. It also checks regularly if taxpayers abide by the tax laws. Accordingly, this current move by the DOF should make us vigilant about the reasonableness of our clients' tax computations, and thus be also alert for these common risks we will be discussing shortly. Please note that the list is not all-inclusive. There are other risks related to income taxes that will not be covered by our discussion. So these are just three examples of those risks. So the first common risk is that unallowable expenses for tax purposes are claimed as deductions from taxable income. Another common risk is that taxable income is not considered in the calculation of income tax. And the third risk is that deferred tax assets are not properly valued. So let's briefly discuss each of these common risks. The first one is unallowable expenses for tax purposes claimed as deductions from taxable income. Because of so many tax rules and regulations in the Philippines, some companies fail to recognize all the expenses that under the BIR rules are not considered allowable deductions for tax purposes. For example, when a company fails to withhold and pay the proper amount of tax on an expense that is subject to withholding tax, such expense is not allowed by the BIR to be deducted from the taxable income. Expenses that are not realized yet, such as mere provisions, are also not allowed by the BIR as tax deductibles. Hence, a company that may not know this rule can mistakenly claim such expenses as deductions for tax purposes also. Moreover, there are several other losses or expenses that are not allowed as deductions under the Philippine tax laws, such as equity in net losses of associates, depreciation on appraisal increase, deficiency taxes, etc. So if the accountant of our client is not aware of the various rules regarding deductible expenses, then the risk of committing errors in claiming deductible expenses becomes quite high also. Another common risk is that taxable income not considered in the calculation of income tax. Similar to expenses, some taxable income may mistakenly not be subject to tax by a company if the company does not know that such income is taxable. For example, income that is not from the core revenue streams of the company, such as other income, may be considered non-taxable by an uninformed company when in fact they are taxable under the BIR rules. I remember during the early implementation of the minimum corporate income tax or MCIT, several companies committed errors in computing the same as they got confused with the tax base used in the regulation, which said that MCIT is taxed on the gross profit. Several companies interpreted gross profit as the difference between core revenues and direct costs, which is basically the gross profit presented on the financial statements. But it turned out that the gross profit alluded to by the BIR also includes all other taxable income and not just the core taxable revenues. Accordingly, many companies who were subject to MCIT were assessed by the BIR for deficiency taxes during that time. By the way, for those not familiar with this type of tax, the MCIT is a tax different from the regular corporate income tax. Unlike the corporate income tax, which is applied against the taxable income, the MCIT rate is applied against the taxable gross income. Under the CREATE law, which we will discuss briefly later, the MCIT rate is set at 1% of the taxable gross income until June 30, 2023. Starting July 1, 2023, the MCIT rate will increase to 2% again, which was the MCIT rate prior to the enactment of the CREATE law. The MCIT is imposed when the corporate income tax is lower than the MCIT. Any excess of the MCIT over the corporate income tax can be carried forward and claimed against the regular income tax for the next 3 succeeding taxable years. Finally, the last common risk we will discuss is the improper valuation of deferred tax assets. As required by accounting standards, the tax effect of future tax benefits should not be recognized in the financial statements if the probability of using such benefits is remote or doubtful. However, a company may intentionally continue to record such assets even if their recoverability is doubtful to increase the company's net worth. Alternatively, the company may just really unintentionally have forgotten to review the recoverability of their deferred tax assets, leading to improper valuation of the same. So keeping in mind these common risks, let us now talk about the principal audit objectives in auditing income taxes. By the way, I would like to reiterate that these common risks are not exhaustive. Other risks may arise on income tax and deferred income tax depending on the circumstances of our clients. So following are the principal audit objectives in the audit of income taxes and deferred income taxes, which we will briefly discuss also in this course. So there are 5. So these are the first 3, and these are the last 2. Let's briefly discuss each of these audit objectives. The first audit objective is to ascertain that all liabilities for income taxes on the balance sheet represent amounts owed to governmental entities for income taxes, and all deferred income taxes on the balance sheet represent amounts that have accrued at the balance sheet date or that are appropriately deferred to future periods. This audit objective addresses the assertion, existence, and occurrence. At the end of the audit, we should be able to ascertain that the income tax payable or prepaid income tax for that matter and the deferred income taxes recorded in the books really existed as of the cut-off date, and the related income tax expense really occurred during the period under audit. I think it cannot be denied that I think many in our country still do not feel happy paying taxes for one reason or another. If anything, paying taxes is deemed an obligation that just hurts the pocket. So why is testing for the existence of the income tax payable is still necessary? Surely a company will not recognize income tax payable if it really does not exist. Well, the answer to this, I think, lies more in the correctness of the income tax computation. For example, did the company really owe the government the tax liability recognized in its books as of the cut-off date? That is, did the company make a correct income tax computation? Was the recognition of the deferred income taxes appropriate given the income tax computation made by the company? So needless to say, when designing the audit program for income taxes, we should ensure that there would be steps that would verify the existence and occurrence assertion in the income tax accounts, especially if during our risk assessment process, such assertion stood out as one of the risks that need to be addressed during the substantive testing phase of the audit. Another audit objective is to ascertain that all liabilities for income taxes owed by the entity and all income tax expenses that had accrued at the balance sheet date have been recorded, and all deferred income taxes that have accrued at the balance sheet date or that are appropriately deferred to future periods are included in the balance sheet. This audit objective addresses the assertion completeness. As I said earlier, not many taxpayers are happy in paying taxes. Accordingly, this is one of the assertions that is most important to income taxes because the risk of a company showing understated income tax payable and income tax expense is relatively high. However, not all understatement in income tax payable is intentional. That I would like to emphasize. I believe that there are not many companies that intentionally understate their income tax payable. I believe that understatement in recognized income tax payable is due more to errors in computing the income tax liability. Bihira naman yung intentionally minamali yung tax computation. As I have mentioned earlier, many taxpayers are not aware of all the numerous tax rules and regulations associated with income tax. Hence, errors in claiming deductible expenses or identifying taxable income arise frequently, leading to the understated income tax expense and liability recognized by the company. The next audit objective is to determine whether income taxes payable and deferred income taxes are included on the balance sheet at the appropriate amounts. This is another one of the more important audit objectives, in my opinion, that needs to be achieved at the end of the audit. And this is to be able to ascertain that the amounts of income tax payable, income tax expense, and deferred income tax payable are recognized at their appropriate amounts. In this regard, it is important that the auditor who will be assigned to audit these accounts have the necessary skill, competence, and knowledge to audit income tax payable, income tax expense, and deferred income taxes. The fourth audit objective is to determine that the income taxes payable on the balance sheet represent obligations of the entity at the balance sheet date. This audit objective addresses the assertion, rights, and obligation. At the end of the audit, we should be able to ascertain that the income tax payable recognized by the company is a liability that is really owed by the company to the government. Finally, the last audit objective we will discuss is to ascertain that liabilities for income taxes, the related income tax expense, and deferred income taxes are properly classified, described, and disclosed in the financial statements in conformity with prescribed accounting principles. This audit objective addresses the assertion, presentation, and disclosure. Full PFRS, PFRS for SMEs, and PFRS for SEs each have their own set of required disclosure requirements for income taxes. Note that aside from the disclosures mandated by the accounting standards, the BIR through Revenue Regulation 15-2010 also requires companies to disclose specific information regarding various taxes. Accordingly, at the end of the audit, we should be able to ascertain that the income tax liability, income tax expense, and deferred income taxes are properly presented, classified, and disclosed in the financial statements following the requirements of the accounting framework our client uses and the requirements of the BIR. Having said that, let us now move on to our main topic, which is the substantive audit procedures typically performed on current income tax and deferred income tax. But before we discuss the substantive audit procedures typically performed on income taxes and deferred income taxes, I would like to stress that as auditors, we are obliged to plan our audit properly. For example, the extent of the audit substantive procedures to be performed and the associated inherent risks with income tax accounts should be determined properly. For those not familiar, inherent risk refers to the susceptibility of an account to material errors in the absence of an appropriate level of controls. This means that as the level of inherent risk on income taxes becomes higher, more substantive audit procedures will need to be performed on the account in order to decrease the remaining risk to an acceptable level. Conversely, as the controls of the company over income taxes become stronger, the extent of the substantive audit procedures becomes lower. Controls cover, among others, retention and training of competent employees and the processes of how the company identify, handle, compute, control, and pay the relevant income taxes. Another key consideration in designing our audit procedures is the determination of the proper risk assertions to be addressed most. We must also be aware of the client's motivation or tendency to intentionally understate income taxes, if any. At the same time, we must also recognize our client's honesty in reporting truthful income taxes. So all of these factors need to be considered in designing the proper substantive audit procedures to be performed on income taxes. But because there are no planning results that we can consider in this training session, we will only be discussing the typical substantive audit procedures performed on income taxes and deferred income taxes. Based on the circumstances of our clients, it is possible that not all of the procedures we will discuss here may need to be performed on the income taxes of our clients, or that additional procedures not discussed here may actually need to be performed after all. So let's start with the first substantive audit procedure that we will discuss today. Please note that the very first thing that we should do is to prepare a lead schedule, such as this for income taxes, income tax liability, and deferred taxes. And then we perform this procedure, which is to perform analytic review on all income tax accounts such as income tax expense, income tax payable, prepaid tax, if any, and deferred taxes. So for this procedure, we initially perform analytic review procedures to determine or identify any possible issues or unusual items that we may encounter during the audit of the account. So basically, inuuna natin ang analytic review. To perform this audit procedure, we compare the account balances with those of prior periods. We also compare the relationships of income tax expense and the current and deferred provisions for income taxes to pre-tax income with prior years. We then investigate any unexpected changes or the absence of expected changes noted during the comparisons made. For example, if the client's results of operations vastly improve from the prior year, but the income tax expense and payable in the current year went down significantly as well, then we should investigate such an unexpected change, because by default, a higher income is usually accompanied by a higher income tax expense. Or if we notice that the deferred tax asset account did not change at all, knowing too well that certain sources of temporary differences, such as the allowance for inventory obsolescence or allowance for expected credit losses, posted movements during the year, then such lack of changes in the deferred tax asset account should be investigated. We can initially inquire from the client the reason for the significant fluctuations or absence of expected fluctuations, and then substantiate the client's explanations by performing the other audit procedures that we will be discussing in a few. So pwedeng tatanungin muna natin yung client, we will just get their opinion on their explanations for the significant fluctuations or unusual fluctuations, and then we'll do further audit procedures to substantiate their explanations. So the next audit procedure is to determine whether rulings and elections that have ongoing applications are still valid. To verify the reasonableness of the current income tax expense and deferred taxes recorded, we do not only check the mathematical accuracy of the computation. Rather, we also determine the income tax rate that is used by the client or the type of deductions it elects. In this regard, we should always apprise ourselves of the newly enacted tax laws and new tax rules and regulations issued by the BIR to assist us in reviewing our client's computation of income tax and deferred income tax. For example, a few years ago, the Train Act was signed into law. This train law, which is the first of the 4 packages under the Comprehensive Tax Reform Program, introduced changes in personal income tax, value-added tax, donor's tax, doc stamps, estate tax, and excise tax on certain products. As you may have noticed, the train law did not have any significant impact on the computation of the corporate income tax. However, the second package, which is called the CREATE Law, did. The CREATE Act, which was just recently signed into law, covered changes in the corporate income taxation because the law included, among others, a change in the corporate income tax rate from 30% to 25% for resident and non-resident foreign corporations, a change in the corporate income tax rate from 30% to 25% for domestic corporations unless such domestic corporation has total assets of 100 million pesos and below and net taxable income of 5 million pesos and below, in which case the corporate income tax rate becomes 20%. The CREATE law also introduced a change in the corporate income tax rate for hospitals and educational institutions from 10% to 1% until June 30, 2023, after which the tax rate will revert to 10%. And the CREATE law also introduced a reduction in the minimum corporate income tax from 2% to 1% until June 30, 2023, and after which the MSIT will revert to 2%. The CREATE law also introduced changes in value added and percentage taxes, repealed the improperly accumulated earnings tax, and also repealed the 10% special income tax rate on regional operating headquarters, among others. So because of changes such as these on the computation of corporate income taxes, we must keep ourselves updated on new tax rules and regulations to assist us in ascertaining that our client uses the correct income tax rate in computing for their income tax expense and deferred income taxes. Moreover, we should also ascertain that the type of deductions elected by our client at the end of the company is valid. For example, if the optional standard deduction or OSD was not used in the first quarterly income tax return by our client, then such client cannot elect to use the OSD for its annual corporate income tax computation. The next audit procedure is to review the income taxes payable and related expense accounts in the general ledger for unusual items. Similar to analytic review, which can potentially uncover unusual items that may need to be investigated further, we also scan the general ledger to identify unusual items that were recorded in the income tax and deferred income tax accounts, if any. I have encountered cases where the company erroneously charges business taxes, such as real property taxes, to current income tax expense account. In other cases, the deferred tax assets are recorded as prepaid taxes, such that when you look at the deferred tax account, the balance is nil, and the prepaid tax account is obviously overstated. Remember, deferred tax asset is not a prepaid tax asset. Another audit procedure is to examine support for tax payments made and refunds received during the period. For significant tax payments, tax refunds, or tax credits received during the year, we must examine the underlying documents such as the submitted income tax returns and the accompanying evidence of tax payments, certificates of creditable withholding taxes, etc. We should then ascertain that such tax payments, tax refunds, or tax credits were properly accounted for in the tax computation and in the books of the company. The next substantive audit procedure is to determine whether any tax authority examinations have been completed during the period or are currently in progress, review completed reports or the status of examinations in progress, and determine whether additional provisions are needed for possible assessments, penalties, or interest. So as part of our substantive audit procedures, and also as mandated by Revenue Regulation 15-2010, which requires information about deficiency tax assessments and ongoing tax cases in courts or bodies outside the BIR to be disclosed in the financial statements that will accompany the annual corporate income tax return, we determine whether there's any ongoing examination being conducted or has been completed by the BIR covering open tax years by inquiring these matters from the management and also by inspecting the notices received by the company from the taxing authority. We usually ask this from the management during the planning meeting. However, after the planning meeting and during the substantive audit testing phase of the audit, we should again inquire this from management kasi possible na during the planning phase, wala pa silang na-receive na notice from the BIR, pero after the planning meeting, pwede kasing mangyari na naka-receive na sila. So we have to make sure that we update our inquiry during the substantive audit, substantive testing phase of the audit. BIR notices that could be examined depending on the stages, depending on the stage of the BIR's examination, include the notice of discrepancy, the preliminary assessment notice, the formal letter of demand, and final assessment notice or FAN. For settled, so we usually ask for these notices from the clients if they have this, if they have received these types of notices from the BIR. For settled BIR assessments, we should take into account the breakdown of the deficiency taxes paid since such amounts impact the income tax computation. For example, the basic tax deficiency is not an allowed deductible expense for income tax computation purposes. We should also ascertain whether a provision or additional provision for the tax assessments is needed to be recognized in the company's books and financial statements in compliance with the requirements of relevant accounting standards such as PAS 27 provisions and contingent liabilities of the full PFRS, Section 21 of the PFRS for SMEs, and Section 16 of the PFRS for small entities. The next audit procedure is to review prior periods returns not yet examined by the tax authorities for items similar to those adjusted or proposed for adjustment by the tax authorities and determine whether additional provision should be made. As we have just mentioned, we inspect assessments or notices issued by the BIR to our clients as part of our audit procedures and as required by RR 15-2010. In this regard, when reviewing these assessments and notices from the BIR, we should pay attention to the comments and findings by the BIR and remind our clients to apply those findings to the current tax returns and tax computations of the client. Let's take this scenario. Based on our review of the BIR's assessment of the prior year's income tax return, we noted that the tax authority or the BIR disallowed the client's prior year rent expense due to non-withholding of taxes. During our current year's audit of rent expense, we noted that the client failed to withhold the necessary amount of taxes from its rental expense again. In this case, we should remind our client to consider such rent expense as a non-deductible expense in their computation of income tax and in the preparation of income tax return to avoid any possible tax exposure in the future. For already filed income tax returns that have not been examined yet by the BIR, we determine whether a provision or additional provision for contingency may need to be provided by our client for identified tax exposures. So kung wala pang notice ang BIR, we take the initiative to see kung kailangang recognize ng provision for contingency. So let's try this audit case. The client's income was subject to multiple tax rates because it had activities that were subject to 5% tax rate and also had activities that were subject to the regular income tax rate. It also used the installment method of computing income taxes for some of its activities, and it also used the standard computation for its other activities. Simply put, the company's tax computation was quite complicated. The auditors, with the help of their tax experts, performed a high-level estimation of the income tax due from the company. When compared to the amount recognized by the company, the income tax estimated by the auditors was higher. In this regard, the auditors propose an adjusting entry to increase the recognized income tax of the company. The client, however, declined the proposed journal entries because they believed that the income tax recorded in their books was correct since their in-house legal counsel agreed to such amount. The client then requested their in-house legal counsel to provide their opinion on the adequacy and correctness of the recognized income tax to the auditor. So they requested the legal counsel to confirm to the auditors the correctness of their income tax computation. So in this case, the question is, in this case, can the auditor rely solely on the opinion provided by the in-house legal counsel and accept the income tax recorded in the book? So since sinabihan na tayo ng legal counsel na they believe na tama yung computation ng client, can we rely on the client's computation already? Kahit na mas malaki yung sa computation natin, mas malaki yung na-compute nating income tax payable or income tax expense. The answer to this question or case is no. The opinion of the in-house legal counsel would not be enough evidence to provide a reasonable basis for a financial statement opinion. As auditors, our education, experience, and training should allow us to be knowledgeable about income tax matters and be competent as well to evaluate how the taxes are recognized and presented in the financial statements. In this case, remember that the auditors were also assisted by their own tax experts kasi hindi rin yung auditors naman nagpatulong din sila sa mga tax experts nila sa computation. So essentially, yung auditors are quite reliable or competent na rin reliable na rin yung computation ng auditors because may tulong na ginawa yung tax experts ng audit firm. But I would like to emphasize that we don't just throw away the in-house legal counsel's opinion. Hindi naman, and just because hindi natin tatanggapin basta-basta yung opinion ng legal counsel na ibabaliwala na lang natin siya. We don't do that. We can still use the opinion of the legal counsel in making our own opinion on the adequacy of the income tax amount. Pwede natin siyang gamitin kung ano may sinabi ng legal counsel nila to help us then evaluate and assess our own computation. However, note that the audit of income tax accounts necessitates a mixture of tax experience and knowledge of the client's business, which we as the auditors have accumulated and put together during our audit. As a result, we should not depend exclusively on the in-house legal counsel's opinion. Should the company continue to insist on not taking up the proposed entry, such an adjusting entry should be carried to the summary of uncorrected misstatements that will be subject to evaluation as to their impact on the fairness of the financial statement. So if the client insists on using their own computation, and sure din tayo or confident tayo na tama rin na rin yung computation natin, then we should carry the rejected proposed entry to the summary of uncorrected misstatements for further evaluation later. So, going back to the audit procedures, the next audit procedure is to determine that all required income tax returns have been properly and timely filed by the client. So, tinitingnan natin dito is more on tax compliance. The BIR imposes penalty for non-filing, non-payment, late payment, or late filing of tax returns within the deadlines. And because there is always a risk of not being able to file all tax returns on time, we also determine as part of our high-level review of our tax clients' tax compliance with tax rules and regulations, whether our client was able to file its tax returns on a timely basis by comparing the date when the tax return was filed with the tax filing deadline published by the BIR. In the performance of such procedure, we also determine whether provisions may need to be made for possible penalties, if any, arising from any noted late filing or non-filing of tax returns. So basically, we make sure or we ascertain, we determine whether the client is able or was able to file all their tax returns within the set deadlines by the BIR. A tax compliance audit is typically performed by a firm's tax experts. However, as financial auditors, which we are, we can also perform the same, but only on a high-level basis. This is because the scope of our audit services principally covers the fairness of the balances, amounts, and disclosures in the financial statements only. So high level lang ang ginagawa natin because hindi naman yun yung purpose ng audit natin, hindi yung detailed tax compliance review ng kliyente. As indicated on the Statement of Management Responsibility for ITR, all the information and representation contained in the income tax return and financial statements accompanying the income tax return are the responsibility of the management, including compliance with the BIR reportorial requirements and tax rules and regulations. The next substantive audit procedure we will cover is to consult with tax personnel on significant income tax matters and coordinate with the tax department the review of income tax accruals, provisions, the status of tax matters, and related financial statement disclosures. Most auditing firms, whether big or small, have tax experts or tax departments in them. The tax group or department is typically separate from the assurance or audit group. A lot of companies, usually the large ones, also have their own group of tax experts. Accordingly, where there are significant, delicate, dicey, or gray tax matters, issues or positions regarding our clients' taxes which we, the financial auditors, may not be fully familiar with, we should consider discussing such matters with the client's tax experts and also consult with our own tax experts to find a resolution to such issues. So pag merong mga complex or complicated tax issues, dapat hindi natin sinasarili. Dapat we should take the initiative of consulting the tax experts. In general, we consider engaging the services of our tax experts. So these are the instances or conditions when we should already consider involving the tax experts. So we engage our tax experts to review the tax computation made and the draft income tax return prepared by the client. So these are usually the services that we ask from our tax experts in relation to complex or complicated tax clients or tax issues. The next one is to perform tax compliance review and also review the disclosures made to the financial statements that are required by the BIR, such as those required under Revenue Regulation 15-2010 and RR 34-2020 for clients, such as, among others, considered high risk. So these are now the types of clients or conditions for which we should ask the first three services, for our tax experts to perform on. So first is yung when our client is considered as high risk, then we should consider involving our tax experts. When our client has complicated accounting transactions, we should consider engaging our tax experts as well. And then clients with highly diversified operations, such as the income tax computations, becomes complicated. So, yung mga companies na complicated ang tax computation, we should consider involving our tax experts also. And other clients that would best be served by our tax experts. So, as long as we think na dapat ma-involve or dapat kailangan natin ng tulong from the tax experts, we should not really just focus and parang tayo lang yung gagawa ng buong audit. Dapat open tayo to involving the services or engaging the services of our tax experts. The next audit procedure is to ask the client whether matters exist that although not recorded in the accounting records or not of significance to the financial statements as a whole, such as penalties or fines resulting from violations of laws or tax penalties, could affect taxable income or the income tax accounts. So aside from inspecting BIR assessment notices, we also ask our clients if other tax matters occur during the year that we should be aware of. An example of this is the impact to the company of any new revenue regulation or revenue memorandum order issued by the BIR or a BIR ruling that was received by the company during the year. Please note that when the company receives a BIR ruling for a certain tax issue, we should inspect and review such BIR ruling and determine the impact, if any, of such ruling on the company's taxes. We usually ask this also during the planning meeting. So dapat tayong lahat, we should make sure that a planning meeting is conducted with the client prior to the start of the audit field work. And then we obtain a calculation of the current year provision for income taxes, including the minimum corporate income tax when applicable. As has been mentioned earlier, the responsibility of computing income taxes and related payables lies with the client. We as the auditors are supposed to verify only the reasonableness of such computation. I would like to emphasize this, because we should only be verifying the computations made by the client. Yun lang ang role talaga natin. Accordingly, as a matter of audit procedure, we should obtain a copy of our client's computation of the current year's annual income tax expense, including the minimum corporate income tax when applicable, and the related income tax liability or prepaid taxes, as the case may be, as of the cut-off date. So we should really ask our clients for them to compute their own tax payable, and then we'll just review the income tax computation made by the client. Next is to verify the computation of provision for income taxes for the current period. When verifying the computation of provision for income taxes for the current period, we try to ascertain the following. 1, the amounts used in the tax computation agreed or were recorded with the or reconciled with the audited accounts. All identified taxable income was included in the income subjected to tax by the client in their computation. We also verify that only allowable deductions as per tax rules were claimed as deductions by the client, that all temporary and permanent differences between the amounts per books and per tax purposes were properly identified. We also make sure that reversals of temporary differences from prior year or years were properly accounted in the current year income tax computation, that the amount of taxable gross profit for MSIT purposes was properly calculated, and that the correct tax rate was applied by the client against the taxable income or taxable gross profit. We also examine a reconciliation of the current period and taxable income, compare reconciling items with those in prior periods, examine support, and establish that all significant reconciling items have been considered. When verifying our client's income tax computation, we examine and review the reconciliation of tax on income per the company's books with the taxable income per tax rules and regulations. So, kino-compare natin yung tax per books and tax per BIR rules. As we know, multiplying simply the profit before tax presented in the financial statements by the appropriate income tax rate will not always result in the amount of current income tax expense recognized in the same financial statements. This is because the accounting treatment and the tax treatment on certain accounts differ from each other. For example, changes in the fair value of certain assets and liabilities can be recognized as either income or loss in the financial statements. However, for income tax purposes, such fair value gains or losses are considered non-taxable or non-deductible because they are not considered real income or loss yet. Another common example is the interest income received from banks. In the financial statements, this is presented as an income that eventually affects the profit before tax amount. However, for income tax purposes, this interest income from banks is removed from the profit before tax amount to get the taxable income. This is because such interest had been subjected by the bank to final withholding tax, and therefore including such items still in the income tax computation will lead to double taxation. So these differences in accounting treatment and tax treatment need to be reconciled. Also, as mentioned earlier, part of verifying income tax computation is examining appropriate and sufficient audit evidence supporting the significant amounts used and reflected in the income tax computation. This substantiation of the amounts used in the tax computation is achieved during our audit of the different account balances. There's no need most of the time to separately perform this activity just for tax computation purposes. Aside from substantiating the significant amounts used in the computation, we also ascertain whether all significant income tax reconciling items have been properly considered in the computation by, for example, comparing reconciling items with those in prior period or scanning the company's adjusted trial balances, audit lead schedules, or work paper documentation. Having said that, let us try to review together a sample simple tax computation. So this is just a simple tax computation. Assume that the total assets of this client as of December 31, 2021 was 50 million pesos, and that this is the income statement of such client for the year then ended. So December 31, 2021. All the amounts indicated in the statement of income are the final audited numbers except for the income tax expense of 532,500 pesos. Based on the income statement, the company had a net profit after tax of 1,600,000 pesos. This amount was arrived at as follows. Sales for the year amounted to 7,500,000 pesos. The cost of sales amounted to 4,600,000 pesos, thus leaving a gross profit of 2,900,000 pesos. The company then deducted from the gross profit various operating expenses totaling 770,000 pesos, resulting in an operating profit of 2,130,000 pesos. The operating expenses were composed of professional fees for 25,000, impairment losses on receivable for 30,000, depreciation for 75,000 pesos, rent for 200,000 pesos, office supplies for 15,000 pesos, utilities for 125,000 pesos, and salaries and wages for 300,000 pesos. The company also earned interest income on its bank deposits amounting to 2,500 pesos, thus making the profit before tax of 2,132,500 pesos. The company then deducted the computed income tax expense of 532,500 pesos, which finally resulted in a net profit after tax of 1,600,000 pesos. So let us also suppose that the amount of impairment losses on receivables coincides with the amount of allowance for credit losses by the company as of December 31, 2021. Ibig sabihin, yung impairment losses on receivables na 30,000 is the same with the balance of the allowance for doubtful accounts as at December 31, 2020. So when asked for the computation of the income tax expense, remember ang income tax expense was 532,500. So when asked for the computation of the income tax expense, the client gave this calculation. The calculation showed that the amount of income tax expense of 532,500 pesos was calculated by multiplying the taxable income of 2,130,000 by 25%. The taxable income, on the other hand, was arrived at by deducting the interest income from banks of 2,500 pesos from the profit before tax of 2,132,500, resulting in the taxable income of 2,130,000 pesos. So let's assume that for purposes of this activity, that the company is not yet subject to MCIT. So RCIT lang ang kukumputin natin for this activity. Let us suppose that the company was able to withhold all the necessary taxes except for rent where no taxes were withheld. We were asked to verify the current income tax expense calculation made by the company. So nakapag-withhold naman siya ng taxes for all the expenses subject to withholding tax except for rent. So the question is, was the current income tax expense correctly computed and recognized by the client? So here's the computation of the client. So just looking at the data, it is apparent that an error was made by the client in calculating its current tax expense. So just by looking at this information here, it is very obvious na meron kaagad na error sa computation. So what is the apparent or obvious error, you may ask? The answer to this is the income tax rate used. Under the 8 law, the corporate income tax rate that will be applied against the taxable income of corporations with net taxable income not exceeding 5 million pesos and total assets not exceeding 100 million pesos, excluding the land on which the particular entity's office, property, plant, and equipment are situated, is 20%. The computation showed that this client has a taxable income that is below 5 million pesos. It was also mentioned earlier that the total assets of the company amounted to 50 million pesos only as of December 31, 2021. Therefore, the corporate income tax rate used by the company in its calculation was wrong because it used 25% instead of 20%. So, dapat 20%. Aside from this glaring error, are there other errors in the computation? Meron pa ba? Well, the answer again is yes. It was mentioned earlier that the client failed to withhold taxes on rent. Because of this, the amount of rent expense would not be allowed by the taxing authority to be deducted from the taxable income based on the prevailing tax rules. The impairment losses on receivables are also not considered an actual expense but mere provisions only. Under current tax rules, mere provisions are not allowed as deductions for tax purposes. These provisions will be allowed as deductions when they turn into actual losses. So based on this, how much should be the current income tax expense for the year ended December 31, 2021? The current income tax expense for the year ended December 31, 2021 should be 472,000 pesos only. This was computed by deducting the interest income from banks of 2,500 from the profit before tax of 2,132,500. The interest income from banks had been subjected to the final withholding tax, hence should not be subjected to income tax anymore. The amount of rent expense of 200,000 pesos and impairment losses on receivables of 30,000 pesos, which we have identified earlier as expenses not allowed for deductions for income tax purposes, are added back to the profit before tax. This will give us the amount of taxable income of 2,360,000 pesos. The taxable income multiplied by the correct income tax rate of 20% results in a current income tax expense of 472,000 pesos. When compared to the computation provided by the client, we can see that our computed taxable income is higher. Our taxable income is 2,360,000 pesos, while the client's taxable income is 2,130,000 pesos. However, our computed current income tax expense of 472,000 pesos is still lower than the income tax expense computed by the client of 532,500 pesos. This decrease in income tax expense is due to the lower income tax rate use of 20% only instead of 25% as used by the client following the provisions of the CREATE law. In this regard, and in cases such as this, we propose a journal entry or entries to adjust the company's income tax expense and income tax payable to correct the account balances. Please note that there is a deferred income tax component that needs to be recognized also against current income tax expense. However, deferred taxation is still to be discussed later in this training session, hence we will not delve into that yet here. Kasi nakita nyo meron ditong deferred income tax. We will discuss this later. So what can we take away from this verification of income tax computation exercise? I think it is clear that it is vital that as auditors, we should keep ourselves always updated with the new tax rules and regulations issued by the BIR, because if we do not update ourselves, baka mali na yung tax rate na nagagamit ng kliyente natin, hindi pa natin alam. It is also important that the financial auditor who will be assigned to verify our client's income tax computation has the appropriate skill, competence, and knowledge about Philippine taxation. And when the client has been identified as high risk, or when the income tax computation becomes complicated, for example, the income tax computation requires different tax rates, such as those for companies availing of fiscal incentives or for those entities using the installment method, the audit team should consider requesting their tax experts to perform the review themselves. The financial audit team can help the tax experts by providing any assistance that the tax experts may need from the audit team in verifying the tax computation. So, make sure na lagi nating kino-consider yung mga tax experts natin. So, the next audit procedure is to determine whether the recorded liability for income taxes is fairly stated based on the current period's taxable income. So, yung tinest natin kanina is the amount that goes to the profit or loss statement. This time, ang i-check naman natin or i-verify natin is the balance that or the amount that goes to the balance sheet. Not surprisingly, in auditing income taxes, we do not only test the reasonableness of the current income tax expense presented in the statement of income, but also the income tax liability reflected in the statement of financial position. To do this, we inspect the quarterly income tax returns of the company to determine the amounts paid or creditable withholding taxes applied, if any, by the company during the first 3 quarters of the year. Note that under the existing rules and regulations, companies are required to file tax returns and pay income taxes 4 times a year. So first quarter, second quarter, third quarter, and the annual income tax return. Payments and unused tax credits during the first 3 quarters, including the prior year's excess tax credits, can be claimed as a deduction from the annual income tax due if the company elected to use such payments and creditable taxes as tax credits to be used in succeeding tax returns. In this regard, to determine the correct amount of income tax payable or prepaid tax, as the case may be, as of the end of the year, we inspect the filed quarterly income tax returns to determine how much tax credits can be claimed against the current year income tax. Determining the amount of taxes paid or creditable withholding taxes claimed can be done during our testing of the company's tax compliance with the tax deadline set by the BIR as discussed earlier. So remember kanina, 'di ba, sabi natin we perform yung test of compliance, tax compliance of the company by checking kung nakakapag-file sila ng tax returns on time. So we examine the tax returns in that procedure. So I would like to emphasize that when we do that, we do not inspect the quarterly income tax returns to determine whether the company was able to file the same on time, or not, and then inspect the same quarterly income tax returns again to determine the amount of payments and tax credits claimed. For an efficient audit, when we review the quarterly income tax returns, we should ensure that we document already both information, that is the date of the filing and payments of tax credits claimed, in our work papers, so we don't have to perform an inspection of the quarterly tax returns twice. So meaning, pag nagta-tax compliance review tayo, kapag nag-examine tayo ng deadlines, meaning tinitingnan natin kung nakakapag-file sila ng returns properly, dapat yung procedure natin hindi lang nakafocus doon sa dates. We should already also examine the returns as a whole. So, magkano yung binayaran, magkano yung kinlaim na tax credits, yung mga ganun, magkano yung ina-apply nilang creditable withholding taxes, magkano yung prior years excess tax credits, etc. So, lahat, minsanan nating nire-review yung returns, hindi tayo magpapaulit-ulit ng pag-review ng tax returns. So, using the same exercise data that we used earlier, the company's unaudited income tax payable amounted to 277,500. As of December 31, 2021, calculated as the client computed annual income tax expense of 532,500 pesos, less the sum of the quarterly payments amounting to 255,000 pesos. The quarterly payments made by the client were 85,000 pesos, 70,000 pesos, and 100,000 pesos for the first, second, and third quarter respectively. Assuming these quarterly payments had been verified to be correct based on the filed income tax returns of the client, do we agree with the balance of income tax payable computed by the client of 277,500? If your answer is yes, then you are wrong and probably was not paying attention earlier. Because if you were, you would know that the income tax expense computed by the client was found incorrect. So let's compute together the proper amount of income tax payable as of December 31, 2021. The correct amount of income tax payable as of December 31, 2021 is 217,000 pesos because the proper amount of annual income tax expense for the year ended December 31, 2021 was 472,000 pesos and not 532,500 pesos, as you may remember. So going back to the correct amount of income tax payable of 217,000 pesos, this was computed by deducting the total quarterly payments of 255,000 pesos from the current income tax expense of 472,000 pesos. Please note that in this example, it is assumed that the client has no valid creditable withholding taxes and unused and unexpired minimum corporate income tax. If the company has those items, however, those items can be claimed against the income tax due as well. When the amounts of quarterly payments and creditable withholding taxes are greater than the income tax due from the company, then the income tax liability will turn into prepaid taxes and thus become assets of the company. Another audit procedure we do is to review the activity in the liability accounts during the period, examine significant items, investigate the amounts of and the reasons for actual and probable adjustments, and verify the composition and computation of the accounts at the balance sheet date. So aside from reviewing our clients' computation of their income tax expense and income tax payable, we also review the activity in the income tax payable or prepaid taxes account during the period to uncover possible errors or unusual items charged to the account. For example, when our client has weak controls over its financial reporting process, it is possible that incorrect journal entries involving income taxes may be made or that entries are posted incorrectly to the income tax accounts. Accordingly, we should be able to account for the proper movement in the income tax payable or prepaid taxes account during the year. The last substantive audit procedure we will discuss about current income taxes before we talk about deferred taxation. So magdi-deferred taxation na tayo in a little bit. So the last procedure is to consider the effects of net operating loss carryover, etc. on the current provision and determine that the recognition of the effects of such items is appropriate. Sometimes the total allowable deductions can be higher than the taxable revenues of the company. Accordingly, instead of taxable income, companies, especially those incurring huge losses before tax, get net operating losses instead. These net operating losses can be carried over in the next taxable years, hence are called net operating loss carryovers or NOLCO. Under RR number 14-2001, NOLCO can be claimed as a deduction in computing taxes per quarter and annual final income tax within 3 consecutive years immediately following the year the net operating loss was sustained or incurred. In 2020, however, the BIR issued RR 25-2020, whereby the carryover period of net operating losses incurred in 2020 and 2021 was extended from 3 years to 5 years. Keeping that in mind, when our client incurs or has prior NOLCO, we should ascertain that such NOLCO is fully and appropriately accounted for by the company in its income tax computation according to the requirements of the prevailing tax rules and regulations. So that's the last audit procedure we do for income tax. Let's now talk about deferred taxation. But before we start discussing the substantive testing procedures, I think we should discuss deferred taxation first because, as I said earlier, many taxpayers are still not familiar with this concept. In my experience in the public practice, I have had clients, usually the small to medium-sized ones, that do not touch the deferred tax balances in their books at all. So, makikita nyo hindi nag-move yung deferred tax balances. They usually wait for the auditors to adjust the account balance during the audit. When asked for the reason, one of the more common explanations given by the clients is because the accountants of these clients do not fully understand deferred taxation, or it is the management itself that do not fully understand the concept and therefore do not compel their accountants to calculate for the deferred taxes. So for those not familiar with deferred taxation, let us briefly discuss this concept first. Remember, if you are an auditor or plans to be an auditor, you will need to understand first how deferred taxation works for you to be able to effectively audit income tax accounts. So let's start. Deferred taxation is covered by PAS 12 income taxes under full PFRS, Section 29 of PFRS for SMEs, and Section 23 of PFRS for SEs. To help you understand the basic concept of deferred taxation, let us define several terms being used in this accounting concept. Note that we are not going to discuss deferred taxation in detail in this training session. That discussion will need to be covered in a separate training course. We will just briefly discuss the following basic terms being used in deferred taxation. The first term is deferred taxation. So what is deferred taxation? Deferred taxation is the process of recognizing deferred tax assets and or liabilities for the expected future tax consequences of events that have been recognized in the company's financial statements or tax returns. What are tax consequences? Well, tax consequences are the effects on income taxes, whether current or deferred, of an event. Please note that some events do not have tax consequences. For example, certain revenues are exempt from taxation and certain expenses are not deductible. Another term we should be familiar with is deferred tax asset and deferred tax liability. Deferred tax asset is the deferred tax consequence attributable to a deductible temporary difference and operating loss carryover. A deferred tax asset is a deferred tax benefit that for financial statement purposes is presented as a deduction from the current income tax expense. Conversely, the deferred tax liability is the deferred tax consequence attributable to a taxable temporary difference. Accordingly, deferred tax expense arising from deferred tax liability is added to the current tax expense for financial statement presentation purposes. Another is temporary differences. You may have noticed that deferred tax assets and liabilities arise only from temporary differences. So what is a temporary difference? A temporary difference is a difference between the tax basis of an asset or liability and its reported amount in the financial statements that will result in taxable or deductible amounts in the future years when the reported amount of the asset or liability is recovered or settled respectively. An example is an allowance for inventory obsolescence. The impairment loss that is charged against the allowance is non-deductible for tax purposes because it is just a provision for estimated losses. But it being non-deductible is only temporary because when the inventories covered by the allowance are finally destroyed, for example, following the requirements of the BIR, then the impairment loss previously not allowed as a deduction can now be deducted for income tax purposes. The last concept about deferred taxation that we will briefly discuss is accounting versus tax. I know many taxpayers who get confused with the concept of deferred taxation, and some of you may still be confused after this. But one thing I wish to emphasize is that deferred taxation is an accounting concept that is governed by accounting standards. Accordingly, the current tax rules and regulations do not cover deferred taxation. In other words, the BIR covers only the current tax expense and income tax liability, but not the deferred tax assets. So let's discuss the audit procedures, the substantive procedures that we perform on deferred taxes. The first audit procedure we perform on deferred income tax is to obtain a roll-forward schedule of activity in the deferred tax accounts. Here's an example of a roll-forward analysis for deferred tax assets. Once we get a copy of this from the client, a copy of this schedule from the client, we should perform the following. First is agree the opening balances to the prior period work papers, and then prove the mathematical accuracy of the schedule as well. Second, we determine the temporary differences are appropriately identified and measured. Third is we review the reasonableness of the tax rates applied to the computation of deferred taxes. This was prepared prior to the issuance of the CREATE law, hence 30% was still used. But by 2021 or 2020, by next year, actually this year and 2021 and succeeding years, we should be using either 25% or 20% already. And then agree the closing balances to the general ledger, and finally, determine that the deferred tax accounts are appropriately classified. The next audit procedure we will discuss about deferred taxes is to test the computation of deferred income tax. To test the computation of deferred income taxes, we identify the types and amounts of existing temporary differences. Remember, temporary differences only, and the amount of net operating loss carry forwards and the remaining length of the carry forward period. Following are examples of temporary differences. So you must be familiar with these temporary differences. Revenues recognized in the income statement but not yet recognized in the income tax return. Revenues not yet recognized in the income statement but already included in taxable income. Expenses recognized in the income statement but not yet recognized in the income tax return. And expenses not yet recognized in the income statement but already recognized in the income tax return. So yung timing difference between income tax return and the books. Once the types of the amounts of temporary differences and the amount of NOLCO had been identified, we then measure the total deferred tax assets or liability for the identified taxable temporary differences using the applicable rate. So let's go back to the audit case we used earlier, where the company made an erroneous tax computation because it failed to recognize certain non-deductible expenses and also used a wrong income tax rate. Among the reconciling items that should have been considered by the company, based on our suggested computation, was the non-deductible impairment losses on receivables. As you can see, the impairment losses on receivables amounting to 30,000 pesos had been claimed as a deduction in the financial statements for the year ended December 31, 2021. But the same amount was not claimed as a deduction for income tax purposes because it was as yet just a mere provision. Because the amount of 30,000 will become deductible for income taxes only when the receivables had been written off, this particular item is considered a temporary difference for which a deferred tax benefit will be needed to be, in which a deferred tax benefit will need to be recognized. Assuming that the company is expected to continue meeting the future threshold, assuming that the company is expected to continue meeting in the future the threshold set by the BIR for 20% income tax rate, meaning hindi nila ma-exceed yung 100 million pesos na total assets and taxable income na 5 million pesos. Then this 20% income tax rate would be applied against the amount of impairment losses on receivables of 30,000 pesos. So depende kung, so for those companies that use 20% as their tax rate currently, let's say, kung in the future, in the next three years or until 2023 at least, or no, wala pa lang, sorry, walang expiration yung 20%. Kung sa tingin ng company, mami-maintain nila yung 5 million or hindi nila mamimit yung 5 million threshold and yung 100 million pesos threshold. Therefore, ang expectation is in the future or in the coming years, ang gagamitin pa rin nilang tax rate is 20%. If that is the case, then 20% ang dapat nilang gamitin in computing for deferred income taxes. However, if the company thinks and believes, at dapat ma-verify natin yon kung sakali, if the company thinks that they will breach the 100 million peso amount of total assets in the future at magkakaroon sila ng taxable income that would be greater than 5 million, then dapat ngayon pa lang at 25% na natin siya i-recognize. Kahit na 20% pa lang yung income tax rate na ginagamit nila, kung at the time na ma-recover nila yung deferred tax asset, nandun na sila sa rate na 25%, ngayon pa lang 25% na yung gagamitin nating income tax rate. Hindi tayo susunod dun sa income tax rate na ginagamit nila currently. I hope that's clear to you. Yung ginagamit nating tax rate for deferred taxation is the rate when they will be able to recover the deferred tax asset or kung kailan nila ma-incur yung deferred tax liability nila. So, yun yung difference between income tax rate and deferred income tax rate. Dati, walang problema kasi 30% yung income tax rate, marirecover mo rin siya at 30%. Ngayon kasi merong 20% at 25% rate na binibigay si BIR under the CREATE law. So, dapat yung mga gumagamit ng 20% ngayon, dapat i-consider ninyo when computing for the deferred income tax of your clients kung ano yung at what rate marirecover nung kliyente yung deferred tax assets na yon. So, among the reconciling items that should have been considered by the company, based on our going back to the case that we had earlier, among the reconciling items that should have been considered by the company based on our suggested computation was the non-deductible impairment losses on receivables. As you can see, the impairment on receivables amounting to 30,000 pesos had been claimed as deduction in the financial statements for the year ended December 31, 2021. But the same amount was not claimed as a deduction for income tax purposes because it was as yet just a mere provision. Sorry. Because the amount of 30,000 will become deductible for income tax purposes only when the receivables had been written off, this particular item is considered a temporary difference for which a deferred tax benefit will be recognized. So assuming that the company is expected to continue meeting in the future the threshold set by the BIR for the 20% income tax rate, then this 20% income tax rate will be applied against the amount of impairment losses on receivables of 30,000 pesos. The resulting amount of 6,000 pesos is a deferred tax benefit which, as we said earlier, for financial statement presentation purposes, is deducted from the current tax expense, deducted from the current income tax expense. In this regard, the amount of income tax that will be presented in the income statement of the company is not just the current tax expense of 472,000 pesos, but the amount that incorporates the deferred tax benefit of 6,000, which is 466,000 pesos, computed as sa 472,000 pesos less 6,000 pesos. So ang lalabas sa financial statements is not the income tax expense is not the amount of 472,000 but 466,000, which accounted for the deferred tax benefit of 6,000 pesos, which is computed as 20% of the 30,000 peso amount of the impairment losses. What about the interest income from banks and non-deductible rent expense? Why did we not calculate for deferred taxes on them? So basically, bakit yun lang? So bakit yung impairment losses lang and not the non-deductible rent expense also and yung income tax, non-taxable income, interest income? Bakit wala siyang deferred income tax? It is because these reconciling items have no future tax consequences and therefore are not considered temporary differences. Hindi sila magta-turn around. For example, the reason for not subjecting the interest income from banks to corporate income tax is because such income has been subjected to final withholding taxes by the banks already. This means that the interest income has been taxed already and will never become taxable again in the future. The same is true with the rent expense. The reason for disallowing the same as a deduction for income tax purposes is because the company failed to withhold taxes on it. And because there is no remedy given by the BIR for these types of expenses to become deductible again in the future, then the rent expense also that does not qualify as a temporary differences. So temporary differences are those reconciling items that will turn around in the future. So meaning kung ngayon deductible siya, pwede siyang maging kung ngayon is non-deductible siya, in the future pwede siyang maging deductible. Sa income, kung ngayon non-taxable income siya, in the future, pwede siyang maging taxable income. Ganun ang temporary differences. May future consequences sila. So the next audit procedure is to determine whether a portion of or the whole amount of deferred tax assets need to be unrecognized or derecognized. This is something that we should always make sure to do every audit. So, kung minsan kasi nakakalimutan natin gawin ito, but it is a must that we should be doing this every year. Accounting standards require that the carrying amount of each deferred tax asset be reviewed at the end of each reporting period. The company should then reduce the carrying amount of the deferred tax asset to the extent that it is no longer probable that sufficient taxable profit will be available to allow part of or all of the deferred tax asset to be utilized. Any such reduction will then be reversed to the extent that it becomes probable that sufficient taxable profit will be available. So to comply with this specific requirement by the accounting standard, we should therefore determine whether a portion of or the whole amount of deferred taxes needs to be unrecognized or derecognized. So unrecognized meaning hindi na natin kukomputan kaagad. O parang before pa tayo mag-compute, ina-assess na natin kung marirecover ba nila yung deferred tax asset or not. If hindi na natin, i-unrecognize kaagad natin. The recognition is when ni-recognize na natin siya previously, let's say last year, ni-recognize natin siya, ngayon i-recognize natin siya, meaning tatanggalin natin siya sa libro. Based on the results of our assessment, we then reduce the deferred tax assets by recognizing the tax effects based on the weight of the available evidence that it is more likely than not that some portion or all of the deferred tax assets will not be realized. We should ascertain that the recognition should be sufficient to reduce the deferred tax asset to the amount that is more likely than not to be realized. So kung ano lang yung recoverable deferred tax asset, yun lang dapat na maiwan sa libro. Our assessment should be based on our discussions with the client's management, inspection and review of relevant and pertinent documents, such as, for example, business plans and minutes of meetings, our overall evaluation of the company's business and operations, and also external factors that affect the company's operations. So dapat kino-consider natin maraming factors. For example, a continuously losing client incurred NOLCO this year. Based on their 7-year forecast, the client expects that the company will only be able to turn around their losses into income after 5 years and thus may probably have a taxable income only on the 6th year. In this regard, it is apparent that the deferred tax on NOLCO this year should not be recognized anymore because the NOLCO is not expected to be utilized before its expiration. So in this case, alam na natin na hindi niya magagamit ang NOLCO ever. Mag-expire siya within the prescription period na hindi siya nagagamit ng kliyente. So if we know that already now, we should not compute for the deferred tax effect already of that NOLCO. So I hope that's clear to you. The last substantive audit procedure we will discuss in this training session is to determine that the company complies with applicable accounting rules regarding the classification of income tax liabilities, prepaid taxes, and deferred tax assets and liabilities, and that income tax and deferred taxes are properly described, presented, and disclosed in the financial statements. Accounting standards do not allow deferred tax assets and liabilities to be recognized as current assets or liabilities. So always remember that ang deferred tax assets and liabilities can never be current assets or liabilities. They should always be presented under the non-current assets and non-current liabilities sections of the statement of financial position. But income tax payable, on the other hand, is presented as a current liability. And also, there are other several information that are required to be disclosed for income taxes and deferred taxes. So if you read the relevant accounting standards, marami pang nire-require na disclosure for income taxes and deferred taxes. So hindi lang yung classification ng deferred tax assets and liabilities and income tax liabilities. Accordingly, as part of our audit procedure, we must ascertain that the company complies with the classification, presentation, and disclosure requirements of the relevant accounting standards for income taxes and deferred taxes. So dapat, I guess, dapat talaga may checklist tayo of the required disclosures for all accounts, including taxes, including income taxes, para ma-ensure natin na kumpleto yung nadi-disclose ng mga clients natin. So to end this training session so basically those are all the substantive audit procedures that we typically perform on income taxes and deferred taxes. But to end this training session, let's briefly discuss the following common auditing issues being encountered in the audit of this account. So these are the typical audit issues na nakikita natin or na-encounter natin during the audit of the account. First is the staff assigned to do taxes is not appropriate. So minsan talaga nangyayari ito. Because of the many tax rules that have to be followed in the Philippines, the audit staff who should be assigned to do taxes should have adequate knowledge about Philippine taxation. This is to avoid, if not minimize, mistakes in testing the amount of tax due from the client. The involvement of tax experts in reviewing the client's tax calculation should also be considered when deemed necessary. For instance, when the tax computation becomes complicated because of the nature of the company's business, or if the client is considered high risk, as we mentioned earlier. Another common auditing issue is the valuation of deferred tax assets. As mentioned earlier, accounting standards require that deferred tax assets should be unrecognized or derecognized when the benefits of the deferred tax assets may not be recoverable anymore. However, some clients fail to do this assessment or may even intentionally continue to recognize non-recoverable deferred tax assets to increase their net worth. O kaya ayaw nilang i-recognize kasi that will increase or decrease their profit, increase their loss or decrease their profit, net profit. Accordingly, the auditor should ensure that such assessment is done regularly so that deferred taxes will be carried in the financial statements at their recoverable values only. Remember, nilalagay natin sa FS ito. So, yung sa estimates and judgment section ng FS, nilalagay natin yung recoverability ng deferred tax assets. So, we should ensure na tinitingnan talaga natin mabuti itong recoverability ng deferred tax assets. And the final auditing issue we will discuss to end this training session is about misclassified deferred tax assets. Accounting standards mandate that deferred tax assets be classified as non-current. Some companies, however, continue to mistakenly recognize their deferred taxes as current. When this happens, the auditors must ensure that proper reclassification is made in the financial statement. So pag nakita natin yung misclassification ng deferred tax assets, dapat nagpo-propose kaagad tayo ng reclassifying journal entries to correct the classifications, the erroneous classification made by the client. So actually, that's it. I hope you learned something from this training session regarding substantive audit procedures performed on income taxes. And I understand that there were questions earlier that were sent earlier even before the start of the audit. And I would just like to go through them before we really end the audit. The questions were, what are income taxes? I think we discussed this already. This is the first part of our third part of our first part of our training session, which is discussing about income taxes. The next question was, what is the effective substantive testing method for income taxes? Substantive testing method, actually substantive testing is a method already. Siguro kung sino may nag-question, I think they mean substantive testing procedures. So my answer is actually the same with all the answers I made during the other training sessions, which is an effective substantive procedure is one that is able to address and respond to the audit risk identified by the team during the planning phase of the audit. So again, pag mali yung risk assessment natin during the planning phase of the audit, then mamamali rin yung audit substantive procedures natin. Hindi rin magiging effective basically. Or kung kahit na tama yung risk assessment process natin during the planning phase, kung hindi naman natin na-design properly our audit substantive procedures para maka-respond siya or ma-address niya yung mga identified risks during the planning phase, then the audit procedures, kahit na anong kahit na gaano ka-extensive pa yung gagawin nating substantive audit procedures, kung hindi naman siya nakaka-respond doon sa risk during the planning phase, then considered pa rin siya as ineffective. So, an effective audit procedure, substantive audit procedure, is one that addresses the identified risk during the planning phase of the audit. Pag na-address niya yung identified risk, then that is an effective substantive audit procedure. Thank you very much. Goodbye, everyone.